The mistake that people make here in trying to achieve this high win rate is they see the market drop on side and very quickly they snatch their winner. Because this is a move, if you just look at these two 1 minute candles, it's a really nice quick move. Two of the big things that always come through in people's kind of definition of scalping is it's tight stops and it's a high win rate. Now, I've always had a slight issue when people use the word tight stop, because a tight stop is a very hard thing to define and ultimately really translates into you don't want to lose much money, which is again a rather subjective thing to try and define. In essence, what people want is the least possible risk, the least possible downside, and the greatest amount of upside, which all sounds great. Of course, you would want that. But a lottery ticket provides you very little downside and massive upside. The problem is a lack of consideration of the probability of these things actually working out. What you've also got to think about is by having tight stops, what you're actually doing is increasing the chances your stops are going to get hit. If we go and take a little example here, and incidentally, I'll actually be looking at this in more detail next week. But this would be a trade to try and play the breakout of this little range and play down to this low. Now, if you forget the levels, just completely ignore the levels on this, what you'll look at is a reasonably straightforward move. Now, the mistake that people make here in trying to achieve this high win rate is they see the market drop on side and very quickly they snatch their winner. Because this is a move, if you just look at these two 1 minute candles, it's a really nice quick move. These two candles, that gets you 20 ticks on side within a minute and a half, 2 minutes. And the temptation is then to go, right, snatch, grab that. I've got myself my winner. Therefore, this is contributing to my high win rate. The problem that you have, though, is you end up in a situation where you either miss trades or you place stops too tight in order to try and mitigate risk, is the perception. So take, for an example, the false break of the low. What someone might do is once you get this rejection candle off the low, they'll then buy it. But rather than put an appropriate stop as a minimum below the low down here, or even really below the actual low, instead what they'll do is they'll look and go, well, I want a tight stop. And so to get a tight stop, they're going to give it 5 ticks worth of risk. What they'll end up doing is getting themselves caught out in this little candle and then watching the market move to where they'd like it to go. This is the problem. You can't have both. You can't have a tight stop, mainly because tight is very subjective. The level of volatility, the level of size of ranges on any day is completely subjective. High win rate is something you can expect. But this doesn't come by snatching winners and taking really tight stops. This comes by appreciating where the market has turned and playing moves to the next available point. What you're trying to do is capture this idea that, well, if there's nothing in the way, of course you're going to the next obvious reference point. So let's say, for example, you're playing the break away from this low, the false break here. Well, if you're playing this, the next obvious reference is back where we came from, which is 66 ticks, 60 ticks from the lows. That's what you're playing for. It's the next obvious point. That's a real key part to scalping. To really understand scalping and to do it well, it's about, to a degree, ignoring the prices. Look at your charts and say, right, this is where I'm buying. That's my next place that I'm getting out. You take the market from one place to the next. Job is done. So that idea that you do have a higher win rate is true. What also scalping gives you, and this is the big attraction to scalping if done right, you'll get higher win rates. You will not get particularly great risk reward. That's fine. What scalping requires, though, is high volumes of trade. If you're looking at two people, and if you look at the green line as a scalper's equity curve and the purple pinky line as a swing trader's equity curve, to reach the same point in P&L, what you will end up with is a scalper doing far more trades, which I know is off-putting for a lot of people. But in doing far more trades, what you're doing is you're smoothing your equity curve, because you don't need big winners to be able to achieve that equity that you're looking for. Say getting up here, whatever that number is to you, 10 grand, 100 grand, a million, whatever the number. What you're doing is you're incrementally moving in that direction, as opposed to trying to get there in big leaps, which is ultimately what swing trading is about. For a swing trade, you will get these big jumps in performance. You don't have a particularly high win rate. You will take quite a lot of losers, because what you're also trying to achieve is a very high risk reward. So if you're trying to play for a, say, 5, 10 to 1 risk reward, you could well be facing some pretty big losers and frequent losers. You're not playing on the basis that you're going to win lots of trades. You're playing on the basis that your winners are so large. So this is the key difference between the two. It's the frequency of trade and essentially the difference in the way you make your money. Scalpers will also, and this is an important thing to recognize, scalpers will go through periods of streaks of winners within a day. You'll get these kind of steady sort of streaks of upside performance versus then these sort of sideways ranges. Essentially, this is where you're working out what exactly is going on. Where this is hard, and we'll try and do a little comparison in a moment between swinging and scalping. Where this is difficult is that ability to sort of take those winners and losers and not see your P&L go anywhere whilst you're working out what the market is really doing. That's another key aspect of scalping. It's participation that's key. To illustrate this further and give you a little bit real world example, this is performance in May from 2 traders. And what we've got here is reasonably obvious difference between somebody who is a scalper. Look at the number of trades done down here, nearly 2,000 trades in a month, and far, far fewer from someone who is a swing trader. Their performance, though, is exactly the same in terms of P&L here. Their win rates are very, very different. A scalper is going to have a much, much higher win rate than a swing trader. So you get the reality of it here. They've achieved almost exactly the same amount by the end of the month, despite going very, very different routes about this. What I'll do next week is we'll actually go and compare the average size of winning trade for each trader, the risk reward of each trader, and look at the sort of more detail in this as well. So we'll look the same too. We're going to actually explore a bit more into that about realistically what have you got to do to achieve those types of numbers.